Hey guys, I'm Ali from FX Scouts. So in this video, I'm going to be showing you how spreads and commissions can significantly affect your trading results, especially if you're trading on the lower time frames. So let's dive straight in. So in this video, I'm going to show you what spreads are and how they affect your profitability, but I'm also going to be showing you how when you trade on the lower time frames, the spread tends to affect you more than when you trade on the larger time frames. And then at the end of this video, I want to show you what typical spreads are. In other words, what you can expect from your broker and how you can know if you're being charged too much. And then I'm going to give you some nifty trading tips. So very quickly, let's just run through what the spread is. The spread is basically the difference between the buying price and the selling price of a financial instrument, or the bid and the ask price of the financial instrument. For example, as you can see here, through the broker capital.com on TradingView, the bid or sell price is 1.11929, while the ask or buy price is 1.11939. If you subtract these values from one another, you get a spread of 1 pip. So this means that if you bought the Euro USD for the quoted bid price and immediately closed your position, which is effectively selling the asset, you would pay the spread, which in this case is 1 pip. And basically you'd make a loss of 1 pip because you'd have to pay the spread to the broker before you gained your profits. So that spread is essentially the broker's profit on each trade that you make. Now, in order to properly understand the spread, you have to fully understand what pips are. And I'm not going to get into that discussion because it's a full video in itself, but I will place a link to a video that you can view about pips in the notes below. On the other hand, if we look at a commission, it's a fee that the broker charges for you to open and close your trade. And it's generally a fixed fee or a percentage of the total volume that you trade. Now, to understand commissions, I want to show you IC Markets' raw spread account. So here you have a spread of 0 pips in exchange for a commission of $3.5 per lot per side. This basically means for every 100,000 units you trade, you'll pay a commission of $3.5 to open the trade and $3.5 to close a trade, or a $7 round turn commission. The spread doesn't really factor here because, as you can see on TradingView, the spread is basically 0. Now, if you wanted to compare the trading costs of IC Markets and Capital.com, you would have to convert it to a dollar amount. So if we traded one lot, whether through a full deposit or through leverage, and the spread was 1 pip, you'd basically pay $10 to the broker, depending on your currency pair, of course. And here I'm specifically talking about the Euro USD. And if you traded one lot on an account like IC Markets' raw spread account, the spread is 0 pips and the commission is $7 round turn. So you'd pay $7 to execute the trade. Of course, your trading costs reduce with smaller trading volumes proportionately. So if you trade only 10,000 units, a tenth of a lot, then you'd only pay the broker $1 in terms of a 1 pip spread, or 70 cents in the case of a 0 pip spread and a $7 round turn commission. And that's why choosing a broker with low commissions and low spreads is always good practice, because it'll basically lower the cost of doing business with them. One thing you have to be aware of is, even though you're only paying a very small percent, or what looks like a very small amount, to the broker with each trade, your trading costs can add up significantly, especially if you're opening many trades throughout the day, or if you're trading on leverage. Next, I want to show you why trading costs will impact your profitability much more on the lower time frames than on the higher time frames. So here again, we have Capital.com on the TradingView platform. This is the 1 minute time frame, and my take profit and stop loss are set at a 1-to-1 risk reward ratio of 1 pip from the entry. So now, to be profitable here, I would need the price to move more than 1 pip above the green, because that first pip will go to the broker, as we saw earlier. Now, on the lower time frames, like the 1 minute time frames, you'll generally be scalping. So you'll be in and out of trades very quickly and therefore making less profit per trade. Because of course, the market moves less in 1 minute than it does in 1 day. But also, you'll be paying the spread to the broker, and the higher the spread, the more difficult it will be to be profitable. Now, if I leave the forecast where it is, but move to the higher time frames, you'll see it's negligible. In fact, it's very difficult to see that 1 pip, because the Euro USD moved over 95 pips on this day. And so if you were trading on the higher time frames, it would make much less of a difference. Now I want to show you another pair with a much higher spread. Now, if we look at the New Zealand dollar, Canadian dollar, where the typical spread is much higher, around 6.6 pips, you can see just how much larger the spread is compared to the Euro USD. This significantly impacts your profitability because, as you can see, the green take profit area is set at 6.6 pips. So you would have to make more than that to make a profit. However, on the daily time frame, it looks much better, as you can see here. Now I want to show you a trick to be able to visualize the bid and ask prices a little bit easier on your trading platform. So on TradingView, if I right click and go to the chart settings, I click on scales and lines, then click on buy and sell and select lines and values, and it displays these on the chart. And I find this very helpful. And lastly, because we at FX Scouts have reviewed so many brokers, we have come to really understand what the trading cost norms are and what the industry standards are. What we find is that the lowest cost brokers charge a spread of around 1 pip or less, sometimes down to 0.6 pips on these commission-free accounts. And the lowest cost commission-based accounts usually have a spread near or around 0 pips in exchange for a commission of $3.5 per lot per side traded, which means a $7 round turn commission. Thank you so much for watching. If you like this video, please give it a thumbs up. And please remember to subscribe if you're not subscribed already, and I'll see you in the next video.